Hello and welcome to Earnings Echo. We put together the most important information about Meta. So, Meta just dropped an absolute monster of a quarter. I mean, completely crushing revenue estimates. But then the market immediately punished them and wiped like 5.7% off the stock. It really comes down to one word, PTSD. Let's get right into the hard numbers.
Sure. So top-line revenue came in at $56.3 billion. That is a massive 33% year-over-year growth rate, which is a solid 1.4% beat on consensus estimates. And looking at the bottom line, reported GAAP EPS was $10.44.
Wait, I have to challenge that EPS figure immediately.
Yeah.
We simply cannot take that $10.44 at face value, right?
No, absolutely not.
Because it's heavily distorted by that $8 billion tax benefit tied to the U.S. corporate alternative minimum tax relief. I mean, that is just an accounting mechanism. It is not a reflection of core operational profitability.
Completely valid point. When we strip out that $8 billion tax benefit, the normalized EPS drops down to $7.31.
Still pretty good, though.
Oh yeah, it still safely beats the $6.82 analyst estimate. But you're right to ask about the 5.7% after-hours stock drop, because honestly, it had nothing to do with current earnings. Management raised their annual CapEx guidance by a full $10 billion.
Wow.
Yeah, so they established a new expected range of $125 billion to $145 billion.
And there's the FY 2022 PTSD. Investors are flashing back to seeing those warning signs of unchecked infrastructure spending. To understand if this panic is justified, we need to know how they are funding this. What exactly drove a 33% revenue surge at this massive scale?
Well, it's an advertising masterclass, frankly. We tracked a 19% growth in ad impressions across the family of ads.
19%.
Yeah, while simultaneously seeing a 12% increase in the average price per ad. And operating margins are sitting at an incredibly robust 41%.
That is rare pricing power.
Yeah.
But looking at the foundation, the family daily active people actually dipped slightly quarter over quarter to 3.56 billion. So as an analyst, I have to ask if the core user engine is finally starting to stall out.
Actually, the underlying data shows zero organic churn. That sequential decline is entirely geopolitical. It traces directly to recent internet restrictions in Iran and blocked WhatsApp access in Russia.
Oh, I see.
Right, so if you isolate and remove those two geographic events, user growth actually remained positive.
Okay, so the core ad engine is humming along just fine. But let's look at where that cash is actually going. Is Reality Labs still bleeding capital at the same rate?
Oh yes, Reality Labs posted a $4 billion operating loss this quarter alone.
Ouch.
Yeah, but the Family of Apps segment generated $26.9 billion in operating income. It easily absorbs the Reality Labs burn while still securely funding this new CapEx cycle.
So they have this highly efficient cash-generating engine funding the construction of basically an entirely unproven AI spaceship. How did management justify that $10 billion CapEx raise on the call? Are we seeing any actual ROI on artificial intelligence already?
CFO Susan Lee was very aggressive in defending the spend, actually. She pointed to immediate monetization. They just deployed their new Lattice and GM AI models. Essentially, they completely rebuilt the algorithmic architecture of how they predict which ad a user will click. And that AI upgrade directly drove a 6% increase in ad conversion rates.
Wow.
Yeah, they are literally making their money back through ad efficiency.
That definitely changes the narrative. I mean, AI isn't just a research project anymore. It's actively sharpening their core business. But the forward outlook wasn't entirely flawless, right? What risks were embedded in that Q2 guidance?
So, explicitly caution that their Q2 revenue guide factors in a range of macroeconomic deceleration scenarios. And she also highlighted persistent U.S. and EU regulatory headwinds.
Right.
Specifically, the ongoing scrutiny surrounding youth safety issues on their platforms.
Let's contextualize all of this with valuation by running a reverse DCF, reverse discounted cash flow model. For you listening, this isn't an exact science predicting the future. Instead, we work backward from the current stock valuation to calculate the future growth rate the market expects.
And right now, at Meta's $1.61 trillion market cap, the reverse DCF reveals the market is pricing in just 7% annual net income growth over the next 10 years.
7%. I mean, for a business that just posted 33% revenue growth, that is historically anemic. The market is heavily discounting the stock.
It really is.
It tells me investors remain utterly terrified of the cyclical ad market, the Reality Labs black hole, and the reality that single-person voting control leaves them with zero accountability mechanisms.
Synthesizing the long-term story here, Meta's core apps are accelerating at massive scale, and they are successfully weaponizing AI to drive real-world ad pricing and conversion.
Which brings us to the final echo for you to take away today. Meta is executing flawlessly on its core advertising machine. But to participate in that upside, investors must be willing to stomach aggressive, multi-year infrastructure spending.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prep. Catch you again soon.